afternoon market news now. Chinese stocks fell as the rest of the Asian markets traded mixed, while Wall Street stocks rallied overnight and oil prices fell. Hong Kong's Hang Seng Index dropping 2.4% and the tech index dropping nearly 5%. Delisting fears continued to be in focus, with the U.S. Securities and Exchange Commission adding Chinese social media platform Weibo to a list of Chinese stocks facing the risk of being delisted from the U.S. The rand, meanwhile, held a 5-year high against the dollar and is on pace for a weekly gain of 2.8% after the central bank raised the repo rate. Now, to talk to us about some of the companies that have published their financials, in particular looking at the property companies, we are joined by the finance ghost as we analyze that particular sector. Thank you so much for joining us. Let's start off with Growth Point. This one is an interesting one because it's often seen as a bellwether for the economy with a market cap of 50 billion rand. What's your sense of what is happening in the property sector when you look at this one?
Stasia, thanks so much. It's always good to hang out with you on a Friday. So yeah, Growth Point's got a market cap of 50 billion rand, which is big. That's only slightly less than if you combine Redefined and Resilient. So this is a seriously large property fund. And the most famous property in that portfolio is probably their 50% stake in the V&A waterfront. And that's an asset that was really wonderful until we stopped getting tourists during the pandemic. It took a really big knock over that period, but it has actually bounced back strongly in the latest result. And I think it would take a brave person to bet against, the value of the V&A waterfront as a property asset. And there's some other stuff in Growth Point. They incubate something called the Growth Point Healthcare Fund. It's a bit like how PSG used to incubate companies and then unbundle them. Growth Point's got some stuff along those lines as well, which is very interesting. And they have all kinds of international stakes as well. They control Growth Point Properties Australia, Capital and Regional in the UK. So there's a lot going on in Growth Point outside of South Africa. But nevertheless, investors do see it as this kind of general play on property in our country. And that's with good reason. The portfolio is enormous. Now, to give you a lay of the land, something I found incredibly interesting when I was just doing some research earlier this morning, the Growth Point website highlights an extended Black Friday sale on office leases. Now, just imagine going back a few years and telling someone there would be a Black Friday sale on taking out a lease on offices. It's just incredible, right? And this is the aftermath of the pandemic. And it gives you an idea of what's actually going on out there in the market with office vacancies. Now, on the whole, for Growth Point, they've just released results for the 6 months to December 2021. Revenue and operating profit were down, but funds from operations and so the cash flows are better, the top line is worse. Their earnings were higher, so property valuations are improving, and so is their net asset value. But the really important and interesting thing is go to page 5 of that results booklet and have a look at the vacancies table. Retail, industrial, that's all looking okay, and it's heading in the right direction. But office has gotten worse. Despite that Black Friday sale, vacancies up from 19.9% to 21.2%. That's like a fifth of the office space is lying empty, which is quite frightening. And for Growth Point, their office portfolio's fair value is slightly bigger than retail. So it's a big dependency for them. They need people back in the office and they need tourists back at the waterfront. But at least the retail side is doing quite well.
The other two companies that are quite interesting is Resilient and Hyprop. And I love the fun fact when it comes to Hyprop. And that one says that Hyprop rents out more space to New Metro than to Truworths, which was quite interesting. What are the interesting dynamics when you look at Resilient and Hyprop?
Yeah, lots of dynamics there. Another fun fact is that they rent out more to Massmart than they do to Mr. Price. And that can only be gain. A retail chain, which we all know is in a lot of trouble. So these are some of the look-through dependencies that the market gets a bit worried about. But Hyprop and Resilient, both very much retail-heavy funds. Hyprop's a lot smaller. It's just over half the size of Resilient. And, that size matters in the world of REITs, I'm afraid, and so does the level of debt, which is Hyprop's biggest problem. So the way the REITs measure this is something called the loan-to-value ratio, which is basically the percentage of debt versus the value of the assets, the properties. And in Hyprop, it was sitting at a dangerously high 45.8% at the end of the previous reporting period. It's now come down to 41.5%, but that's still high. A lot of the REITs aim for sort of 25 to maximum 35%. So Hyprop's debt is hurting the valuation without a doubt. And so is some of their underlying exposure. The South African portfolio is around 60% of value. Europe is around 28%. And that's sort of the wrong side of Europe. It's very much Eastern Europe, which was fun until about a month ago, let's face it. Now, the reversions in Hyprop are pretty rough. They're retail reversions minus 13%, office minus 18%. What reversions mean is when you sign a new lease, you bring in a new tenant and they renew their lease, or the old tenant renews the lease. This is the difference between the new rental and the old one. So a reversion of negative 18% means that even when they fill an office, that new tenant is paying way less. And this is quite scary when you look at high properties like Canal Walk, Clearwater Mall. These are not funny little regional properties. This is good stuff. If you look at Resilient, they've got about 27 retail centers. Their recovery is well underway. Their portfolio has been revalued higher. They've got stakes in other businesses like Lighthouse, which is focused on Western Europe rather than Eastern Europe, which has turned out to be a good idea. And they'll be unbundling some of that stake to their shareholders. But their loan to value is the key. It's sitting at 28.8%. It's steady versus the end of the last period. And it's in that range you want to see in a REIT, which is why the discount to NAV in high prop is enormous. Whereas in Resilient, it's actually only about 10%, and they're still trying to find ways to close it. So high prop is actually on the radar for a few people as a speculative play in the property sector. And in an incredible coincidence, yesterday's closing share price for Resilient was the same as high prop's NAV, to the cent, which, I mean, those two are not related. It was just an incredible coincidence.
Yeah. Unfortunately, we have run out of time, and it always happens, and it always is the case when we are actually analyzing some of those interesting factors that you are noticing in the market. And I would have loved to touch on what is happening with storage, especially the recent UK acquisition. But unfortunately, we have to leave it there. Thank you so much to the finance ghost talking to us about the SA property sector that happened to emerge from the lockdowns and the trading restrictions. And we are still seeing that there's a bit of a long road ahead for these property sectors. But let's take a quick break. When we come back, we'll have Your Money and SME on Point. That is it from me.